The index fund is without a doubt the most popular investment vehicle out there. Long touted as being the best investment to buy and hold for decades and live off of during retirement, these types of investments have millions of fans and investors. And considering an S&P 500 index fund will earn an average annual return of around 8 to 9%, they've no doubt helped millions of people pay for expenses during their retirement years. Now, I personally invest in index funds myself, but if you watch my channel regularly, you'll know that I'm a much bigger fan of the higher yielding dividend investments. And these investments often get a lot of criticism from investors, particularly the kinds of holdings that I like to pursue, like business development companies, closed-end funds, REITs, and so forth. For one thing, if you invest in higher yielding dividend investments in a non-retirement account, it's no secret that's going to translate into much higher taxes. And certainly with higher yielding ETFs and especially closed-end funds, they do charge much higher expense ratios than index funds do. But the truth is, many of these higher yielding stocks can be more dependable than index funds at times. And many of them are much better investments during retirement than index funds are. I know a lot of you aren't going to believe me, but in today's video, we're going to run the numbers and we're going to take a look at which investments actually fare better during retirement, the index fund or higher yielding types of investments. What you're looking at is the Backtest Portfolio Asset Allocation tool from PortfolioVisualizer.com. This is a really amazing tool that shows you the historical performance of an investment portfolio over the course of someone's retirement. You can put in how much money you have invested, how much you'll need to withdraw in retirement each month, and enter a bunch of different stock, ETF, and mutual fund ticker symbols and see how a portfolio would have performed over time. Today we're going to use this tool to see and compare the performance of some high-yielding dividend investments and your more traditional index funds. We're going to see which have seen the best performance over time and which types of investments would have provided you with the more lucrative retirement. For our first example, let's assume we have $1 million saved up in SPY, which is an S&P 500 index fund, and that we retired on January 1st, 2000. Going forward, we're not going to contribute another penny into our brokerage account. That $1 million is going to be it. Back then, having $1 million saved up was often considered enough in order to retire off of, and it was a pretty big deal to have that much money back then. We're going to assume you need to withdraw $4,000 a month in order to cover your expenses. It could be more or it could be less depending on the month. If you spent the month in your rocker out on the patio, you obviously wouldn't need this much money. It could also be a lot more if you had a medical emergency or an unexpected repair come up. But for our example, we're going to assume an average of $4,000 a month, and some of that will cover taxes if it happens to be in a non-retirement account. When it comes to dividends, we're going to reinvest them since that's basically what every index fund investor would tell you to do. We're also going to say yes to inflation adjusted. That means depending on inflation throughout the years, you'll need to withdraw a little more each year to have your money go as far as $4,000 did when you first retired. So now, considering all of the growth the S&P 500 has seen over the last 23 years, with $1 million saved up in an S&P 500 index fund, how much money do you think someone would have today living under these circumstances 23 years later? If you guessed $0 and 0 cents would be left, you'd be absolutely right. In fact, according to the Portfolio Visualizer, you would have run out of money all the way back in 2017. That's really shocking when you think about it. $1 million was a lot of money back in 2000, and you would have had absolutely no way of knowing that you'd run out of money in just 17 years. You spent decades investing in something that was touted as being very safe and dependable, and it's not even unreasonable to believe that your retirement might last longer than 17 years. I certainly hope it does. But under this scenario, a person would have outlived their retirement savings, which is a serious issue that all people need to think about who aren't building a portfolio of higher yielding dividend investments. If you're living solely off the capital of your investments, you don't have a crystal ball to know if your savings are going to last you 20 years, 30 years, or whatever. But now let's take a look at a different example, leaving everything the exact same. You retired on January 1st, 2000 with $1 million saved up. You still want $4,000 a month, and we're going to adjust that for inflation. Only instead of using an index fund, we're going to go with one of the higher yielding dividend investments that I've talked about on this channel before. One fund I like that I mentioned in a video about 2 months ago is the PCM fund by PIMCO, ticker PCM. This is a closed-end mutual fund that currently yields over 10% and pays monthly dividends. We can see over time this fund has lost 37% of its share price, which is pretty scary, right? It also has an expense ratio of 2.3%, which is awful, isn't it? People who only like index funds certainly won't like that. But let's go ahead and run this for our example anyways. Again, assuming we won $4,000 a month from our $1 million investment in PCM, how much money would we have in our brokerage account today, if any? Despite withdrawing $4,000 every month from this expensive fund that's lost over 37% of its share price since inception, you'd still have money in your brokerage account today. In fact, you would now have over $3.3 million in there. That is insane to think about. The index fund, the very investment that people love, would have done you so wrong had you accidentally chosen to retire at the wrong place at the wrong time in history. Again, my goal for this video is not to bash index funds. I own index funds for diversification, and the truth is that if you were that SPY investor and you saw your portfolio was tanking, you would have been smart enough to realize that you need to withdraw less and reduce your lifestyle choices and stuff like that. You wouldn't be left high and dry and homeless. The index fund still would have served you quite well. In fact, if you waited 1 year to retire in 2001 instead, you would still have money left. But seeing how much it's been going down, I hope you don't plan on living another 5 years or so. Going back to PCM, let's run it again, only instead of $1 million, let's imagine you only happen to save up $750,000 for retirement. So you made the choice to put it all in PCM. We can see not only your $4,000 a month expenses were fully covered, but your $750,000 was still able to grow to now $1.4 million, almost doubling. This is why I love higher yielding investments. A lot of them have good track records, and even though some of them have flatlining or even slowly declining share prices, the massive dividends can still deliver incredible returns on your investments. And we just saw that you don't need $1 million in order to live a very comfortable retirement. Yes, you are going to have to pay more taxes if you're doing this in a non-retirement account if you want to, but at least you'll still have money to live off of, right? Think about it, these results speak for themselves. Let's use some more examples using the high-yield investments I normally like to talk about. Ares Capital, ticker ARCC, is my favorite high-yielding business development company. We'll see the results of investing $1 million in this stock with $4,000 a month in withdrawals adjusted for inflation. A couple things though. First, you should never put all of your money into a single stock. You'll want to diversify across different holdings for safety in case there's a dividend cut. Ares actually did experience a moderately sized dividend cut during the financial crisis. Secondly, Ares wasn't a publicly listed company in January of 2000, so we're going to assume that you retired in October of 2004 since ARCC was launched around that time. Also, having $1 million in this stock would result in you earning more than $4,000 a month in dividends, so what we're going to do is we're going to assume you took the $4,000 in dividends and reinvested whatever dividends you had additionally beyond $4,000. And when I say $4,000 a month, Ares doesn't pay dividends monthly. What I mean is, it's actually $12,000 a quarter, which I divided by 3. So how much money do you think would be left today if you were withdrawing $4K every month? You would now have over $4.6 million. Again, that's after withdrawing all of that money every single month. That's despite the dividend cut that Ares went through. You still made it through the storm and have a significant amount of money left over. You could start taking out more than $4K every month, or it'd be a nice amount to pass on to a loved one in a trust. I could go on, and you're free to use this calculator for yourself, but these results highlight a major downside to index funds that nobody ever really talks about. And that is, if you happen to retire at the exact wrong time, it can cost you significantly later in life. Sometimes the difference between waiting a month to retire can be significant, and you have no way of knowing if you're picking the right month or the right year to retire. But when you build up positions in higher yielding investments, despite the fact that many of them see flatlining or even negative share price growth, they actually fare much better and are more dependable. But it's important that you never ever chase yields, never automatically invest in the highest yielding stocks you can find. You still have to do your research to determine if what you're putting your money into is dependable. But I hope this video at least opened your mind to considering higher yielding investments if you haven't done so already. In our examples, we were withdrawing $4,000 a month, but imagine if you weren't taking any money out and you were just reinvesting all of your dividends to create a bigger and bigger snowball effect. It's ultimately your choice if you want to save in index funds for decades or start investing in higher yielding investments before retirement. They're both great retirement saving strategies. But if you want more high-yielding stock ideas, then feel free to check out some of the other videos on my channel. It's all geared towards these higher-yielding investments. Be sure to perform your own research and come to your own conclusions before making any investment decision. Feel free to subscribe to this channel if you liked what you saw, and thank you all so much for watching today's video, and until next time, take care.